So this leads us into a discussion of taxation. Uh, and so basically, as we will see, taxes um, prevent markets from being efficient. So let's first think about why. Let's think about some of these questions with regard to taxes. Why do we pay taxes? Well, we pay taxes so that the government can provide some public goods like police forces or fire protection forces, parks, roads, right? Things that the public sector generally will not provide, simply because, well, it's because they are public goods, and there are incentive. Those public goods lack the incentive for profitability. So we can't expect the public sector to provide these types of things. So that's why we pay taxes, so that the government can provide them for us, because we as a society have deemed them either necessary or desirable. What are some different types of taxes? So sales tax is one that students commonly know of. There's also something called excise taxes, which is the types of taxes on gasoline and cigarettes that we experience. And so we'll talk about these different types of taxes. All right, so let's think about something called tax incidence. So suppose that the government imposed an excise tax on milk. So just so we're clear, an excise tax is different than a sales tax. A sales tax is usually imposed as a percent tax, so 7 or 8% or 10%, somewhere in that region. So that if you spend, say, $100 at Best Buy, and the sales tax is 7%, you're going to end up paying a total of $107. Whereas with excise taxes, it's a fixed amount per unit. So for gasoline, for example, I think it's somewhere around 50 cents per gallon is the excise tax on gas. Here in the state of Georgia, I think the excise tax on a carton of cigarettes, or a pack of cigarettes, not a carton, a pack, is somewhere around a couple of bucks. But it's a fixed amount per unit. So that's what an excise tax is. So suppose that the government imposed an excise tax on milk. So it would be like $1 per gallon of milk, for example. Well, a good question is then, who pays for the tax? Is it buyers or is it sellers? Well, this is really a question of the tax incidence. Okay, so what is tax incidence? It's the burden of the taxation on the party who pays the tax through higher prices. And so the tax incidence, the burden of the tax, which I will use sort of synonymously as tax incidence, is tax burden. The burden of the tax is independent of who actually pays the tax, who the tax is levied on. And we're going to talk about that in more detail here. So a lot of times taxes for political reasons are charged to the seller. Okay, so we don't want to tax the buyer. We're going to tax sellers, right? It seems more politically favorable for politicians' constituents. Oh, that politician has my interest in mind. They're not going to tax me, the buyer. They're taxing those greedy, money-hungry firms, the businesses, just like they should be, right? Well, yeah, that sounds nice, but what is the firm ultimately going to do if they have to pay a tax on something? They're going to pass that cost, or at least some of it, on to the consumer. And so that's what we're talking about when we talk about burden. The tax might be levied, right, against businesses or against firms, the production side, but ultimately buyers are going to pay at least some fraction of that tax, even though it may be levied against sellers. So that's what we're talking about here with tax incidence or tax burden. All right, so let's think about this and how we can use this in our model, right? So in our supply and demand model. So we could think about a tax on buyers as a decrease in their willingness to pay, right? So a dollar tax on a gallon of milk would reduce buyers' willingness to pay by $1, right? So maybe I'm willing to spend $4 on a gallon of milk, and if the government's going to charge me $1 for a gallon of milk in terms of tax, then really what that does is shift my willingness to pay down to $3, so that I can I guess really my willingness to pay is still $4, but one of those dollars is now part of the tax, and so if you ignoring the tax, my willingness to pay for the milk, ignoring the tax, is now reduced from $4 to $3. And so we can represent that as a shift in the demand curve to the left or down, if you want to think about it in that way. But it's basically reduces demand, right? The tax reduces demand. It shifts the demand curve down by $1, which is the amount of the tax. Okay, so what are the effects of this? It has a couple of effects. So the first effect is that it decreases equilibrium quantity from 1,000 gallons of milk down to 750 gallons of milk. So that's the first effect. It decreases quantity. The second effect is sort of the price. The price without the tax was an equilibrium price of $4, which is what the buyer paid. And it is also what the seller received, right? So without the tax, what the buyer pays is exactly what the seller receives. When the government introduces the tax, that changes. What the buyer pays is going to be different from what the seller receives, right? So with the tax, in this example, the buyer is going to have to pay now a price of $4.50. And then if we take the $1 tax away from that, the seller receives $3.50, right? So the buyer pays $4.50, the government takes $1, and the seller receives $3.50. So basically what the tax is doing is it's driving what's called a tax wedge between the price that buyers pay and the price that sellers receive, okay? And the height of the wedge is the amount of the tax, the $1. Okay, so that's the other effect, is that it has an effect on the price that buyers pay and the price that sellers receive, and it drives a wedge between them. All right, so that's one way we can look at this with our model, assuming that the tax is on buyers. Let's now assume that the tax is levied on sellers. Okay, so this basically increases their willingness to sell by $1, shifting the supply curve to the left or up by $1. And if you notice here, the effects are basically exactly the same. The quantity is reduced from 1,000 to 750. The price that buyers pay is $4.50, and the price that sellers receive is $3.50. And so this is really what we mean when we say that the tax burden or tax incidence is completely independent from who the tax is levied on. It ultimately does not matter whether the tax is levied on buyers or whether it's levied on sellers. It ends up giving us the exact same result in the market. There's literally no difference. Okay, so that's kind of interesting. So just to recap, right, just to compare both cases, when the tax is levied on consumers, some of the burden is passed to producers since the market price falls, right? So back here in this picture, some sellers are hurt by this because they are now earning 50 cents less per gallon than they were without the tax, right? They were able to sell at a price of $4 without the tax. Now they can only sell at $3.50. So they're basically picking up half of the burden here when the tax is levied on buyers. And half of the burden of the tax is on buyers, right? So you can see what the burden is when you compare the prices that buyers pay and sellers receive, and compare that to the price without the tax, right? So sellers are losing 50 cents a gallon, and buyers are paying an extra 50 cents a gallon. And so in this case, in this example, buyers and sellers are basically splitting the burden of the tax. And it doesn't matter, regardless of whether buyers are paying the tax, like buyers are levied the tax, or sellers, the tax is levied on sellers, it basically doesn't matter in terms of market outcome. Consumers and producers are equally splitting the burden of the tax incidence, right? So the incidence in both cases is the same. Okay, so that's what we're talking about here. Tax incidence is independent of who the tax is levied on.